A corporation earns $12 billion in profit and pays an effective tax rate of 9%. You earn $58,000 and pay 24% before Social Security and Medicare even touch your check. How did we get here? In the 1950s, corporations paid effective tax rates close to 50%. They actually contributed that amount to federal revenue. Today, after decades of lobbying and policy changes, the average large corporation pays closer to 9%. Some pay nothing at all. Graphic line chart showing corporate effective tax rate decline from 1950s to today. Here's exactly how the gap was created. Corporations use accelerated depreciation to write off buildings and machinery in just a few years, even though those assets generate profits for decades. This creates massive paper losses that erase taxable income while the company keeps growing and earning real money. They deduct every dollar of interest paid on billions in borrowed money. A company borrows $8 billion and deducts hundreds of millions annually in interest payments. This turns debt into a tax advantage that working families could never access. They claim research and development credits for routine software updates and minor product improvements. An algorithm tweak becomes research. A packaging change becomes development. Billions in credits for normal business operations. They shift intellectual property to subsidiaries in Ireland, Bermuda, and the Cayman Islands, where tax rates are close to zero. Profits disappear offshore on paper while operations and sales remain here. Graphic map showing profit shifting to tax havens. Each provision was sold to Congress as a narrow incentive to encourage investment or job creation. But stacked together, these deductions and credits eliminate tax liability completely. Some corporations report record profits to shareholders while showing losses to the IRS. Meanwhile, your wages are taxed the moment you earn them. Federal income tax hits first, then state income tax, then Social Security and Medicare take another 7.65% with no exemptions and no deferrals. You cannot create paper losses. You cannot shift your paycheck to Ireland. You cannot deduct your commute or your work laptop or the clothes you wear to your job. Every single dollar is taxed in full the moment you earn it. The tax burden has shifted dramatically over 70 years. In 1952, corporate income taxes funded 32% of the federal government. Today, they fund less than 7%. Graphic pie charts comparing revenue sources 1952 versus today. Payroll taxes on workers now carry over 40% of the load. You are funding roads, schools, defense, Social Security, and Medicare, while profitable corporations pay almost nothing. This is not an accident or a market failure. This is policy designed by corporate lobbyists over decades. Small businesses without legal teams pay their full share because they lack the resources to exploit every loophole. Workers without accountants pay every dime because wages are taxed automatically. The system actively punishes work and rewards wealth accumulation through deliberate design. If you think a corporation earning billions should contribute more than a worker earning 60,000, research effective corporate tax rates at the Institute on Taxation and Economic Policy. Share this video so others understand how the system shifted the entire tax burden from corporations to working families over the last 70 years.